buckets. So we have all these various buckets. We're going to take a particular type of investment, we're going to put it into the correct bucket, and then we're going to use that accounting treatment for that particular type of investment. And so the way we first are going to differentiate investments is by debt versus equity securities. So a firm can have an investment in another firm's equity, their common stock or preferred stock, or they can have an investment in another firm's debt, their bonds or any other type of debt that they might be issuing. Both of these are considered investments. The debt securities, one way to differentiate between debt and equity is that debt securities have a specified maturity date. So there's going to be an end when all of the obligations associated with that debt are done, and they're all paid back. Okay? So most debt, that is the case. Equity securities represent an ownership interest, and they normally will go forever unless the business goes out of business. And so equity is an ownership share. Now there are a variety of financial instruments that have some attributes of debt and equity, and sometimes it's kind of hard to tell what it is. Under US GAAP, we have to say it's either equity or it's debt, it's not both. And so examples of like preferred stock, stock options associated with long-term debt, those types of things, they have to be separated. It's either equity or debt. And we're going to either use the accounting rules for equity or debt for those things. Internationally, it's actually different. I'll just mention it very briefly. So internationally, if you have one security, you can actually split it into two parts and have some of it in the liabilities and some of it in your equity section of your balance sheet, the exact same item. And so under US GAAP, they have to be one or the other. Summary of accounting for investments in equity securities. So we're going to start with equity, and on the next page we will do debt. So if we're dealing with equity, the key idea with equity is how much influence or control you have over the other company. So the idea here is it could be that if we buy shares of stock ownership in another company, we could be buying 70% of the shares of this other company. And if that's the case, we have complete control over that other company. We can fire all of the managers, we can change it from a pet store to a nail salon, or do whatever we want. This is our stuff, we can do whatever we want. We have complete control of this company. So if that is the case, we have what we call control, and the rule of thumb is that we typically own more than 50% of the stock. And if that's the case, we use something called the consolidation method. So we consolidate all of the assets and liabilities and equity and revenue and expenses and gains and losses. All of those are basically lumped together with our own stuff and consolidated onto our financial statements. So if you look at any large company, what you're seeing is a consolidation of a bunch of companies lumped together. Because, for example, Microsoft probably owns 50 other companies. And if they own at least 50% of them, all of their assets, liabilities, revenues, expenses are all lumped together on that one financial statement. Essentially, if you own 50% of the shares of another company, that company is part of you. Essentially, that's what's going on. We will not get into the details of consolidation. That is a topic for an advanced accounting class. In fact, most advanced accounting class, it's about half of the class you spend talking about consolidations. And so we will not talk about the specifics of it, but the basic idea is you take all their stuff and you consolidate it with your financial statements because they're basically part of you. All right, so the next category is, let's say we don't have control, in other words, we don't have more than 50% of the voting shares. Let's say that we have what we call significant influence, but not control. And so the rule of thumb here is somewhere between 20% and 50% of the shares of stock. We would say that we have significant influence, but not control. We can't change that place from a pet store to a nail salon, but we can influence some of the choices that they make. Maybe we influence them to use this particular supplier, or we have one person on the board of directors that can influence some of the things the firm chooses to do. So you can't control what's going on, but you have influence over the company. So 20-50% of the shares of stock, the method we use for that is something called the equity method. The equity method, I don't think I want to describe that right now, do I? I guess I will briefly. The equity method, investments are initially recorded as cost, so whatever you pay for the investment goes on your books initially. And then you are going to make adjustments according to a number of things to that value at the end of each period. You're going to make adjustments associated with the net income of that other company. Your portion of that net income adjusts the value of your investment, as does the dividends. And there's also usually an adjustment for a couple other items that we'll deal with when we can talk about it more specifically. All right, that's enough talking about the equity method. Okay, so we have equity. If we have control, we use the consolidation method. If we have significant influence but not control, we use the equity method. If we do not have significant influence nor control, then we use a passive method, or also known as no significant influence. We use the fair value method. Typically, it's if you own less than 20% of the shares of stock. So these rules of thumb of the 20% and 50% don't always hold. There are cases where you own 30% of the shares of stock and you do not have significant influence. An easy example of that would be you own 30% and someone else owns 70%. Well, they don't care what you say. They're going to do whatever they want because they own the company, basically. And you're just along for the ride. There's exceptions going the other direction as well, and you can think through when that might happen. If, for example, you own 15% of the shares and no one owns more than 20% of the shares, well, then you have some significant influence because no one owns a large portion of the shares of stock. When you have a passive investment, you're basically just along for the ride. Whatever the company does, you get the results of it. If they pay out dividends, great, you get that. If the value of the stock goes up, great, you get that. If not, that's too bad. That's just the way it is. This would be any of us if we invested in a company. So for example, you invested in Apple. You're just along for the ride. If the shares of the stock go up, great. If they go down, that's not so good for you. But you can't go into Apple headquarters and tell them what to do. And you can't go into the Apple store and tell them what to do either, just because you own some shares of stock. You're just a passive investor. The fair value method for passive investments, the basic idea is it's going to be valued at the fair value of those investments. Most of these have markets that they're traded on, so you can kind of default into the market value is what they're going to be valued at. So at the end of each period, you're going to determine the market value and you're going to move your investment to that market value at the end of each period. Now there's two categories within passive investments. Okay, so how many buckets have we figured out so far? Consolidations, equity method, and within passive there's two more, so that's four at least. Trading and available for sale. So within passive investments, they can either be classified as trading or available for sale. The difference between these two is not about your influence or control. This is about your intentions. So if your intentions are to hold this investment for a short period of time to try to get a gain, that is called a trading security. If your intention is anything other than that, it's an available for sale security. So if your intention is to hold it for a short term to get a gain, it's considered a trading security. And if your intention is anything else, then it's an available for sale security. All right, so within equity, we have four categories. Consolidations, which is when we own more than 50% of the shares, and we have control. When we have significant influence, which is when we own between 20 and 50% of the shares, we use the equity method. And then when we own less than 20% of the shares, it's either trading, when we plan to hold it for the short term, or available for sale when we do not necessarily plan to hold it just for the short term. We don't know what we're doing with it, or we plan to hold it for the long term. The difference in accounting between the trading and available for sale securities is that both of these, first of all, are moved to their market value at the end of each period. The difference is where those changes in value go. If they are trading securities, then changes in fair value are reported in net income. So if you have the share of stock and it's $100 last period and now it's $110 and it's a trading securities, that $10 difference will increase net income this period. If it's available for sale, then it does not affect net income. If it went from 100 up to 110, the balance sheet would go up to 110, but there would be no effect to net income from that change. And instead, it would go into other comprehensive income, or accumulated other comprehensive income on the balance sheet, which is an equity item on the balance sheet. So essentially, instead of going into net income, and then eventually to retained earnings, which is in the equity section of the balance sheet, it skips net income and goes directly into the equity in accumulated other comprehensive income. And we'll talk about dividends as we move forward. All right, any questions about the classification of these four items?
What about this cash dividend received on
We'll talk about that as we move forward. Well, I guess I'll mention it very briefly, but we'll talk about it again. For the fair value method, when you receive a dividend, it's considered revenue. When you're using the equity method, it is not considered revenue, it's a reduction in the asset. And we'll wait and we'll talk more about that when we get there, but that's the basic idea. And then there, for consolidations, doesn't matter, because it's two. All right, so that is equity. And now here on the next page, we're going to go to debt. Now there's going to be some things that are similar between equity and debt, but there's going to be some significant differences. So there are basically three categories for debt securities, and all of them are considered passive. So the passive investments we had on the other page, these are all considered passive. Why? Because even if you were the only person to lend this other company money, that doesn't necessarily mean you suddenly have control over the company. In fact, you may not even have significant influence. So we ignore influence and control when we're talking about debt. We just assume they're all passive. The three categories are held to maturity, trading, and available for sale. Trading and available for sale are the same as for the equity on the previous page, and are accounted for essentially the same way. So the way that we classify between these three is all about intention. So if you lend money to another company, buy the bonds of another company, and your plan is to hold them for the short term, it's a trading security. If your plan is to hold them all the way through maturity, in other words, however long the bond is, you plan to never sell it and just actually get the cash flows associated with the debt, then you classify them as held to maturity. If your intention is anything other than those two things, the default is available for sale. Yes, sir? Held to maturity is if you plan to never sell it. You plan to actually receive all of the interest payments and then whatever balloon payment is going to happen at the very end. Your plan is to hold it all the way to the end and never sell it. That's a held to maturity security. The accounting for held to maturity is completely different than any of the other ones we've looked at. And so they're actually very careful to separate this one from the other two because there's a lot of potential for cherry picking between these things if you're not careful. All right, so held to maturity, the company has the intent and ability to hold to maturity, trading, bought and held primarily for sale in the near term to generate income or short-term price differences, and they're not the other two things that's available for sale. For both of these, just like previously, they're going to be held at their fair value. Held to maturity is not. It does not get marked to its fair value at the end of each period. Instead, we use something called the amortized cost. So think back to your principal's days. You learned about bonds. You remember learning about bonds? Just a little bit? Okay, do you remember premiums and discounts? Okay, that is what we're talking about when we're talking about amortized cost. We're going to talk more about that in the future, not in this chapter, but in the future. But that's what that amortized cost is. It's the carrying value of the, in this case, investment, which is going to be the face amount plus or minus the discount or premium, and which one it is. So the key difference is that thing right there, what's on the balance sheet. These are both going to be marked to their fair value. This one's going to be just use the amortized cost, which we'll come back to later. And then the difference, the biggest difference is right here. Changes in fair value for trading securities, unrealized gains and losses, in other words, changes in value affect net income. Changes in value for the available for sale do not, and neither do they for the held to maturity. Anytime you have a realized gain or loss, in other words, you sell, realized meaning we sold something, no matter what category we're in, that always affects the income statement. So if you actually sell something, that's going to affect the income statement. The key differences happen when we're talking about unrealized gains and losses and if those affect the income statement or not. And for these three, the only one it does is the trading securities. All right, skip the rest of that. All right, I've kind of already said these things. Significant difference in held to maturity reported at amortized cost with changes in fair value not recognized. Trading reported at fair value with changes in fair value reported in earnings. Available for sale reported at fair value with change in fair value reported as part of other comprehensive income. So those are the three options if you're dealing with debt. So for the quiz, I'm going to give you some information like we invested in the debt of this company and we're planning to hold it for 2 years. So after what I just said, what category does it have to be?
Debt security.
Okay, I've heard lots of categories.
It's a debt security.
Okay, so first of all, can it be a consolidation? No, because it's not equity. Can it be the equity method? No, because it's not equity, right? Equity method has to be equity. Okay, now we have three categories left. Is it held to maturity? Well, let's assume that maturity is 10 years from now, and we're going to hold it for 2. Can it be held to maturity? No. Can it be a trading security?
No.
No, that's not short term. 2 years is not short term. Short term is meaning 30 days. That's short term. So what does it have to be? Available for sale is the only option. Do you see how that works? So that's not the answer. Actually, I don't know what the answer is on the quiz.
So how do you classify long term? Is it more than 10 years?
For differentiating between what things? Held to maturity?
Yeah, how much? Yeah.
Held to maturity has to go all the way to the end, to the maturity. Whatever the maturity is, if the maturity is 1 year or 50 years, whatever that maturity is, it has to be held to that long. So it all depends.
So you said short term is 30 days? Or
I mean, I'm just-
trading, or you just like,
So for trading versus available for sale, it's going to be short term, as in a month or 2. That would be a trading security. Anything longer than that, I'd probably not call it trading security. It'll be really obvious on a quiz or an exam which one I mean. If you know the differences between them.
So, so there's 7 choices total.
So let's think about this. So we have consolidation, equity method, trading, available for sale, and held to maturity. 2 of them can be either debt or equity. So trading and available for sale could be either one.
Got it.
But there's essentially 5. And there's actually a 6th one we'll mention briefly, but it's less important. So those are basically the 5 that you need to be able to differentiate between. There are some other categories. There's, I can't think of it off the top of my head. When you have one thing that is affected by the variation in something else, that's called a derivative. Thank you very much. I couldn't think of the name. Derivatives are counted for slightly differently. And there's a couple other categories like that, which we're going to ignore for this class. We're just trying to get the really big categories in here. Yeah, but those are the 5 that you'll need to be able to differentiate between. And then in the quiz, once you figure out which one it is, then you're going to do journal entries for it. And we'll be doing some journal entries for these in just a minute. Other issues, for held maturity trading available for sale, both debt and equity, if there is an other than temporary decline in value of an individual security, write it down to the new cost basis and include the loss in income as a realized loss. This is like an impairment. So if for example, if you own equity in a particular company and the company declares bankruptcy, you probably should impair that value of that asset, probably to zero, more than likely. And so if that's the case, immediately you reduce it down to whatever the appropriate amount is, and that's going to be a realized thing that goes on the income statement, no matter which category you're looking at. For held to maturity trading available for sale, if the market value cannot be determined, then we use, this is my sixth one, which is only sort of a sixth one, what we call the cost method. It's basically any time that we would like to use the fair value or the market value, but it's not available. Then we use what's called the cost method. Basically the cost method, whatever price you put on your books for, the price you pay for it, that's what you put on your books, and it stays there forever unless you impair it. That's the basic idea. And so for the quiz and the exam, I wouldn't worry too much about the cost method. So that won't be one that you need to say, it's not the cost method because of this. You can if you want, but you won't be required to. All right, so all of these, except for consolidation, are going to be assets that go on our balance sheet. Yes?
Oh, no.
Okay. So what are they going to say on the balance sheet? What is going to be the category that they fall into? What are some of the names you might see on the balance sheet?
Investments.
They might be just called investments. They might be called marketable securities, is another common phrase. It could be called, sometimes they call them by the category. Sometimes they call them trading securities. Sometimes they call them equity method securities. So there's a variety of names you might see on an actual balance sheet. Some of them use the category, some of them just call them investments, some of them just call them marketable securities.
So when you call like marketable securities,
It could be any of those categories except for consolidation. I probably wouldn't call equity method ones those either, but other than that, it could be any of the other ones. Excuse me.
And why not consolidation?
Because you don't have an asset on your balance sheet. You have cash and inventory and buildings all get put on when you consolidate. You don't have an individual investment asset that goes on your books. So the classification, if they're trading securities, they're always going to be in the current asset section because they're for sure going to be sold within a year. Usually much shorter than that, a month or two. Securities classified as available for sale or held to maturity may be either current or non-current depending on what your expectation is when you're going to sell these things or when they're going to mature, if you're talking about held to maturity. Equity securities using the equity method are always non-current assets. They have to be. And then consolidation obviously is not an asset. In the statement of cash flows, trading securities are typically, any cash flows associated with those are going to be in the operating section, and typically available for sale and held to maturity are going to be in the investing section. Not always the case, but that is the most common place to find those items. All right. See this right here? You are not concerned about this right now. You will be concerned about this in about 3 or 4 weeks. So, in this textbook, in chapter 12, they go through investments held to maturity. This is an example of a held to maturity item. And then again, when we get to chapter 14, we do bonds from the perspective of the issuer. Well, essentially what happens is the accounting from both sides are mirror images to each other. And so the textbooks asks us to teach it in chapter 12, and then again teach it in chapter 14. Well, I'm choosing to skip it here in chapter 12. And when we get to chapter 14, we're going to talk about it from both perspectives, both the issuer and the investor's perspective, because they're mirror images of each other and they make sense to go together. So this is an example of the accounting for an investment that is held to maturity. It's just like the bonds you dealt with from the perspective of the issuer back in your principles class, if you remember that at least somewhat. Except now they're investments instead of liabilities, and you are going to be paying out cash initially and receiving cash later on instead of the opposite. And you'll see when we get to chapter 14 that they really are just mirror images of each other. And so we're going to learn it all together there in chapter 14. But this is what we're talking about when we're talking about held to maturity and the amortized cost. The value that's going to be on your balance sheet is the carrying amount of the bond, which as you can see for this example, it's going to grow until you hit the face amount at the end. And then if you had a premium, it would do the opposite. This is what's going to be on the balance sheet when you're talking about held to maturity investments, and what's going to be on the income statement is going to be this interest revenue, and then, well, interest revenue primarily. So, you don't need to know how to do this now, but you will here in a couple weeks. But what you do need to do is example number 2.